When Amazon had hit $5 billion in market cap, and it's probably going to sustain this revenue growth rate in the 20 to 30% range for 20 years. Nobody believed that. Well, that's exactly what happened. The first whole human genome was sequenced in 2003. The cost to do so was $2.7 billion, and it took 13 years to get there. We were not ready for prime time. That $2.7 billion to sequence one human genome is down to $200. That 13 years is down to a couple of hours. We have never seen this amount of technologically enabled disruption in history. You have to go back to the late 1800s, early 1900s. Internal combustion engine, telephone, electricity, to see a true technology revolution.
What regulation would you like to see around AI, if any?
To regulate AI right now would have been like regulating the internet in the late 80s and early 90s before we really understood its ramifications. Safety, security is paramount, but we've seen other industries regulated out of business, and a really good one is nuclear power. Regulation really can hold innovation back.
When we interviewed Howard Marks in March of this year, he observed it's the pioneers who get the arrows. And what I've learned is that in investing, the main way you gain unusual success is by doing things that other people don't want to do. It's hard to achieve singular success by joining the herd. Well, many consider a 21st century investment pioneer to be Cathie Wood. She embraces disruptive innovation themes early, has faced intense criticism during large drawdowns, has reshaped ETF thinking, and is characterized as bold, influential, controversial, and might be America's foremost investor in disruptive innovation. So Cathie Wood, you're on the line from New York. I'm here in London. Welcome to the Money Biz podcast.
Oh, thank you, Simon. I'm delighted to be with you today.
Well, when we interviewed James Anderson of Lingotto and formerly of Bailey Gifford, we asked if he'd been a particularly curious child. And Cathy, for you, I would like to ask you if you were curious or contrarian or both.
Because we traveled a lot as a family. So I lived in England for 5 years. Lived in Ireland. Both my parents are from Ireland, and lived all around the United States. I think what happened in my travels is that, put it in new situations. I had to figure out life just as a little kid. And it became fun after a while because I was able to move from one situation to another and not become a chameleon, but actually become more of who I am, which, yes, I was very studious, perhaps to a fault. And yet I think my big inspiration in the business came from my first job in New York City, which was with Janus and Associates. Sig Segalis at Janus and Associates knew Mr. Hewlett. He knew Mr. Packard. He knew Gordon Moore. And he really, really inspired me.
So I gather that your father was a radar systems engineer, which is a very specific discipline. Did that make the conversations around the dinner table quite technical?
It made the topics of education and career quite topical. My father, an immigrant from Ireland, got his education in the Air Force and realized how important education was to achieving the American dream. He did it, but it was hard because he didn't have that college degree. So the dinner table was all about education and career. He is and was a very serious man. My mother, on the other hand, was full of joy. So it was a great partnership.
Fantastic. Well, let's stay with education before we get to the investing world. You study at USC, University of Southern California. And I read, and you'll have to correct me if I'm wrong, that you studied under Arthur Laffer, who, of course, is the great supply-side economist famed for the Laffer curve. For those of our listeners, although they're nearly all professional listeners, of course, it's the Laffer curve that sought to find the optimal tax rate that maximizes government revenue, which, if too excessive, disincentivizes work and investment. a problem that this UK government has not yet understood. However, how influential was he in developing your thinking?
So art inspired me incredibly. So my father always wanted me to take an economics class. And being the sort of teenager rebellion, just like, I'm not going to do that until I did everything else, and then took an economics class and fell in love with it. Because, and especially with art as my professor, what he did is he pulled us into not only economics, but geopolitics, and made sense of the world, or at least asked questions about the world we were in. I find that very interesting. He started the class with a joke, always, then with current events around the world. And then by the end of the class, before we knew it, the board was covered with equations. Like he had pulled us in. Lured us in to what became very technical classes, but he did it in the context of the real world, and that's a real gift. And yes, I owe a lot to art. He introduced me to Capital Group, the very first firm. I joined in the business. I was in college when I did, and I joined in economics, and the rest is history. I owe him so much that when I started ARK, I gave him 1% of the company.
Wow, what a great story. Well, this may dovetail with the work part that we're now moving to, but when and what was the first stock that you bought?
Oh gosh, I remember the certificate because we had to do it physically. And I cannot, I remember the certificate. I just don't remember the stock, but I do remember saying, this is a lot of work just to buy, and it was $100 at the time, buy $100 of whatever that was. But I'm sure it was when I was at Jennison Associates. So that was the first company in New York, where I worked. And so it must have been a technology stock.
Capital Group, Jennison, Alliance Bernstein, you were an analyst, became a portfolio manager, you ended up as CIO of Alliance Bernstein. You were there for, I think, 12 or 13 years. How did those experiences shape your investing style?
Yes, well, starting at Capital, deep research, very analytical, and challenging but fun. And in fact, when I got to Capital, I said, wait a minute, people in this business are paid to learn. I love this business. I want to do this. So right then I knew. And then I did get the opportunity to move to New York. And at that time, it's not like today where remote was possible even. It wasn't possible. But the New York City was the global financial center. And if you made it in New York, you could make it anywhere, right? The old Frank Sinatra song. And so when I got the opportunity, I took it. I felt I needed to be there. And I worked in New York City for 40 years. First with Jennison, 18 years there. And Sig Sigalis, the chief investment officer, another huge inspiration in my life. He knew Mr. Hewlett, he knew Mr. Packard. And like my father, he knew that we were at the dawn of the electronic age, as my father would say it, and that this was going to be very important. It's going to transform the world. And so Sig inspired me as far as technology, and that kind of dovetailed with, everything my father thought was important as well. So it was a very natural evolution. So I started in economics, but I said to Sig, look, I love the research that we're doing in technology, and I would love to be a part of it. Well, what happened there was, I was the new kid on the block, and Sig said to me, all right, fine, we want you to grow, but I am not going to ask any of our analysts to give up any of their stocks to you. You have to find your own universe. And so what happened? I was like a little dog under the table, looking for scraps. and this company named Reuters. In the UK, people called it Reuters, I think, but we called it Reuters. This was going to be the first dual listing for any stock in the United States, London and US. And it was categorized as a database publishing company. And so when our analyst teams heard about it, the tech analysts didn't want to follow it because it was publishing. And the publishing analysts didn't want to follow it because it was databases, so technology. And so I said, I'll take it. And of course, what that evolved into eventually was the internet, right? It was the earliest days of this convergence between and among industries. And so I had the pleasure of analyzing it and any other database publisher at the time, but really understanding the internet. So I had become a portfolio manager in 1990. I knew a lot about what was happening because of that experience. So that was important. And then moving over to, I did a jog between Jennison and Alliance Bernstein, a hedge fund with one of the other portfolio managers. We left because she was managing her family's money. So that's how I went global and learned more about hedging. And then finally, at Alliance Bernstein, during the middle of the tech and telecom bust, the CEO at the time, Bruce Calvert, felt, okay, we need to bring an outsider in for the first time as a portfolio manager because, this world is changing much more quickly than we expected. And so I came in as the CIO for global thematic strategies. And really what I was doing there was, with my economist hat on early days, I was saying, look, too much capital, chasing too few opportunities too soon. The technologies are not ready. The costs are way too high. We are taking our position, at least in the portfolios I managed, in technology down from the high 30s to 11%. That's where we bottomed. And of course, the benchmarks were in the 35% range at that time. So that was many people don't know that part of this story because they think I'm just such a tech bigot. But I'm not. If we see too much capital chasing too few opportunities too soon, with an economics bias, I'm going to be saying, wait a minute, this is not going to end well. And it didn't end well. And we did better than most, I would say. And so it's very relevant to today because we're getting the question, are we in a hype cycle? Right. But the reason I had to start ARK, just to finish off this question, is after the tech and telecom bust, and even more so after 0809, investors became very risk averse. And they defined safety by their benchmarks. When I started in the business, benchmarks, we might occasionally put them in a report just as a courtesy, but we were not measured by them on a quarter-to-quarter basis the way it is now. And I felt that the world had moved towards too much benchmark sensitivity as the seeds that were planted during the 20 years that ended in the tech and telecom bubble and had been germinating for the last 25 to 30 years, they were beginning to flourish. And so I wanted to set up a firm that focused exclusively on technologically enabled disruptive innovation because we were going to meet or fulfill an unmet need, and that is research and investing in this new world.
So you've already jumped ahead, which may be symptomatic of your great skills in looking forward. However, I want to close the loop, first of all, because there is an irony. I think I'm right in saying Reuters was run by, that stage CEO was Peter Job, and he went to the same school I did, although he was older. And our sponsor today, one of our sponsors, the Stock Exchange Group, which of course houses the old Reuters business. And as you probably know, it's owned 5% by Microsoft and is a data and information business. So there you go. Now, I'll now jump onto ARK. I had to, as I was doing my research and sitting there, sort of an ironic smile crept across my lips because, of course, Noah's Ark was the ultimate preservation vehicle, as was the Ark of the Covenant for the Ten Commandments. So were you having a little tongue-in-cheek moment when you named it Ark?
It really wasn't tongue-in-cheek. Actually, it was much more serious than that. There is a backstory. The SEC was not going to let us capitalize all three letters unless they stood for something specifically. And so within 2 seconds, when our general counsel came in and told me this, I said, okay, active research knowledge. So that's what went into the prospectus, and that's what many people know. What they don't know is that in 2006, I knew that I probably needed to think about starting a new company or starting a company within Alliance Bernstein. And I knew I was going into battle against broad-based benchmark style investing, and that we didn't fit neatly into any consultant's matrix. But I felt it was really important to do it because technology began to permeate every sector, every industry, blurring the lines between and among sectors. And I just felt it was important to get there and do this and generate a lot of alpha if you compare us against broad-based benchmarks as this new world evolved.
So we're going to talk about a number of those issues, and I'd like to start with the investment principles. And I spent time looking at your website, and I have to salute your firm and you because it is a really good website, and I look at a lot of them as part of the research. We think ours is quite good, but I did share it with the team and say, what can we learn? However, you detail your investment principles, and there are 5, but I'd like us to focus on 3: disruptive innovation driving exponential growth, the S-curve and speed of adoption, and macro and thematic. And let's start with that first one. Disruptive innovation drives exponential growth. Why exponential?
Well, the working assumption in financial markets, especially in the equity market, is this became the working assumption that the growth rate, any rapidly growing company, would inevitably see its growth decay to GDP growth rates. This is the dividend discount model and so forth. And exponential growth basically says, no, something's happening here to sustain that very rapid growth rate. So when Amazon in 2002 or 3 had hit $5 billion in market cap, we were trying to convince investors, including our colleagues, that wait a minute, Amazon is the leader in transforming retail from offline to online. And it's probably going to sustain this revenue growth rate in the 20 to 30% range for 20 years. Nobody believed that. Well, that's exactly what happened. If you had applied a dividend discount model to Amazon in 2002, with that dynamic, it would have been a screaming buy. And so what we often say is, if you give us a 5-year investment time horizon, we are a value investor. Nobody believes that because of how high our multiples are now relative to the market. But if we're right on exponential growth, then our companies are going to grow into those multiples. And we make the assumption that multiples are going to compress anyway, just as a part of our discipline.
Got it. So that's clearly expressed. So then you need to help me understand the S-curve adoption, because we look at the fast growth and then we look at the leveling out that's typical of many companies. To what extent does it require as much imagination of the future as it does modeling?
It requires both, but I'll tell you, we rely much more on modeling. And our model is centered on something called Wright's law. Now, Wright's law is a relative of Moore's law. You know Moore's law from the semiconductor space. Moore's law is a function of time. Every 18 months to 2 years, twice the power at the same cost, or some derivative of that. So Wright's law is a relative, but it is not a function of time. It is a function of units, and it is working better today in the semiconductor industry than Moore's law is. Wright's law says for every cumulative doubling in the number of units produced by a new technology, costs will decline at a consistent percentage rate. So for every cumulative doubling, 1 to 2, 2 to 4, 4 to 8, and we're looking for low bases here, costs will decline at a consistent rate. So to give you a sense, to bring this to life, industrial robots, a lot of people are talking about robots now. And they have been talking about robots for the last 25 years, but they haven't been ready for prime time. In fact, most of them were locked up in cages because they were too dangerous. For every cumulative doubling in the number of industrial robots produced, costs decline by 50%, 50. And we're beginning, now that sensors have been applied to robotics, so they're not as dangerous anymore. They can work alongside human beings. We're beginning to see the scaling in industrial robots, the unit growth dynamics. Just another example, for every cumulative doubling in the number of whole human genomes sequenced, costs decline 40%. And just to bring to life the drama here, the first whole human genome was sequenced in 2003. The cost to do so back then, so 22 years ago, was $2.7 billion. And it took 13 years to get there. We were not ready for prime time. And yet biotech was a part of that bubble. Today, where are we? That $2.7 billion to sequence one human genome is down to $200. That 13 years is down to a couple of hours. We are ready for prime time.
Yep. And interestingly, the biotech universe, as we know, has become much unloved, creating all sorts of opportunity. But that's not my question. In fact, I had another question on robotics, but I can be able to scrap that one. Let me stay with the third of these principles that are important, and that's the marrying of the top-down, macro, and thematic with the bottom-up. Just talk us through how you put those two together.
Sure. Any new technology that comes our way, we're going to start doing original research on it through the lens of Wright's law to try and understand what the learning curve looks like. The learning curve is expressed in terms of cost declines. What is it? And I just gave you Wright's law. As we're doing that work from the top down, trying to see, are we within 5 years of seeing this new technology being discounted in terms of valuations in the market? And if we say yes, we start on our bottom-up work. Now, many portfolio teams use benchmarks as a screen for their portfolios. We do not. I don't even know what's in benchmarks. I mean, over time I've learned, but the screen for our portfolios is our research, starting with the top down, as I first described. And as we're moving into, just to give you an example, as we're moving into the autonomous mobility world. So what is an autonomous taxi or a robo-taxi? What is that in 2014 when we started the company? Well, Tasha Keeney was just doing original research, working with academia, looking at Elon Musk's master plan, working with technology companies, and actually throwing questions out there on social media, like, and sharing research saying, it looks like a robotaxi, the brains or the central nervous system, those are going to be GPUs. This is in 2014. And when she came in and told us, I said, "Are you sure?" Because Nvidia at the time was nothing more than a PC gaming chip company. Yeah. Nothing more. And so that became our original research, took us to the stock. We already owned it for gaming, but here we had a whole new business. And then we hired someone from Nvidia, and he educated us. Wait a minute, this is not just about robotaxis. Robotaxi is going to become one of the first AI projects in the world. This is about AI. So we understood very quickly, very early, how important NVIDIA was going to become. Nobody cared. Nobody cared until the ChatGPT moment.
Got it. So this, of course, drives us into this question I have of idea generation. It was James Anderson who made the comment when we interviewed him that fewer people are trying to identify those truly outstanding companies which are outliers because of the 1 year performance. Yes. And I can add to my question, given the power of AI now, and I think it was actually Charlie Munger pre-AI who said he only needed one person in his research team. How are you sourcing ideas and how is it changing?
So I think this is very important. And then I'll get up to our bottom-up steps so you understand. Our research team is organized very differently from traditional research teams in our business. Most research organizations the responsibilities are broken down by sector, industry, sub-industry, with many firms very proud of the fact they have 5 healthcare analysts and 5 consumer analysts. Our research team is broken down not by sector industry, but by technology, because we believe that these technologies, so there are 5 major innovation platforms, they involve 15 different technologies. We believe these technologies are going to scale across sectors. Why did we get Tesla right, or earlier than most? Because we didn't define it as an auto company. We didn't give it to an auto analyst who was expert in industrial combustion engine human-driven cars. We gave it to 3 people: a robotics analyst, an energy storage analyst, and an AI analyst. 3 analysts collaborating. And we came up with a better model and an understanding of the S-curve dynamics at Tesla. You asked about S-curves before. So if we've got 3 platforms feeding each other, we've got 3 different S-curves at work, right? Each of these has a different learning curve. And so what that means is these S-curves are going to feed each other. So I'll take you to a higher level than just exponential growth. How about super exponential growth? And that is defined as a company that is growing quickly, but is entering new businesses and is going to accelerate its revenue growth from very high rates already. Now, I know Tesla is controversial because economics and politics have gotten in the way of unit growth. We think that changes with robotaxis, and then beyond that with humanoid robots. Thank goodness Tesla is no longer an EV manufacturer. It is so much more than that. But those are the risks we have to consider as well. That unit growth dynamic is critically important. So from the bottom up, we have 6 metrics that we think are very important to innovation companies. The first one is company people, so management and culture. And we need visionary leaders with a strong point of view about the way the world is going to work, probably because they have introduced the new technology, and able to stand up to short-term oriented shareholders, whether in the public market or the private market, and spend aggressively in the short term to capitalize on these longer-term opportunities. So that's the first. The second is moat. What is the barrier to entry here? And usually it's some technology, sometimes it's patents, less so over time. More and more it's becoming speed at which the technology is taking off. And then there's execution. For us, execution does not mean did this company hit its operating margin to the decimal point. For us, it's more important is this company spending enough on R&D as a percent of revenues? And perhaps more important than that even is, are they spending these dollars in the right places? So to give you a good answer or example of what pulled us out of a stock, Toyota. The EV market was Toyota's to lose. It had the Prius, right? But the government pivoted after Fukushima and basically said, we cannot support transportation on our grid. We're going to go to hydrogen fuel cells. We sold Toyota. We had already done the analysis saying that infrastructure is not going to scale like EV infrastructure. So that's execution. Product and service leadership, that's market share, that's sentiment. We get a lot of sentiment from our social media contacts. We give our research away, not when it's finished, but as it's evolving. And we get a lot of feedback, obviously. And we want all of that feedback, as long as it's constructive one way or the other, challenging us in particular. And then the last two are valuation. And we get a lot of questions there because many people who do not understand ARK think we'll pay anything for a stock. We will pay any price if it's in the right space. That's just not true. We, from a valuation point of view, make the assumption that whatever the premium multiple a stock has at the moment, that is going to decay over the next 5 years toward a market multiple. So a huge headwind in terms of performance as valuation compresses. Our analysts and our portfolio managers have to believe that the revenue growth and margin expansion is going to overwhelm that margin compression. And then the last stage of analysis is thesis risk. What could get in the way? What could interrupt the unit growth of this company? Remember, unit growth is the most important variable. I mentioned politics can, regulation can, COVID did. COVID got in the way of all kinds of unit growth. And another technology disrupting our disruptors is another risk. So we're looking at thesis risk to help us size our position.
So when we bring this up to the market, and you don't look at benchmarks, but most of us do, but it's about the constitution of that market. I think over the last 100 years, 70 companies have provided half of the return over bonds, but that's come down from 90. Now, do you think that it is shrinking? Partly because of passive, which may or may not be challenged when we get a recession and unemployment reverses a lot of those inflows. Because I think it was the Santa Fe Institute that said when Microsoft went public in, whenever it was, 86, you become more dependent on intellectual capital, which increases your returns to scale.
I do think indexation is one of the reasons for concentration in the markets. The Mag 6 or the Mag 7 certainly prove that out. The indexation movement started, as I mentioned, in earnest during the tech and telecom bust, and even more so in 08-09. If we are right on the amount of disruption, we have never seen this amount of technologically enabled disruption in history. You have to go back to the late 1800s, early 1900s, internal combustion engine, telephone, electricity, to see a true technology revolution. If we're right, then there are going to be huge winners, but there are also going to be big losers. And those are in the traditional world order. The world really hasn't changed very much in the last 125 years. Now we're going to see change, and people are getting this idea because AI is moving so quickly that it is going to be very disruptive. perhaps even to the Mag 6. I think Tesla's in the right position, but the others have challenges, and some are going to handle them well, and some are not going to handle them well.
So you're right there on my next question, but I'm going to just pause because I had written that if obsolescence is the result of innovation, aren't those new winners that we all know that have become the household names actually more vulnerable, and their ratings perhaps too optimistic?
It depends. Now, one of the transformations we expect, a lot of these companies are really capitalizing on data about us. We as individuals, we don't control that data, but it's valuable. And in the world of blockchain technology, we may be able to take that back, and enable people to see our data, but we give the permission. If that happens, all of these data aggregators, primarily the Mag 6, will have their economic models will be challenged. Now, Google is responding to the threat beautifully. We see with Gemini, it has some of the best AI researchers in the world, thanks to DeepMind in the UK. Thank you. Thank you very much. So it is, I think ChatGPT put Google on red alert because it's going to lose its search business. And that's about 2/3 of its business. It's going to lose, but it can recreate. Gemini is an attempt. And with Gemini, they are trying to transform into more of a ChatGPT-like experience. But they're going to have to share the market. That said, their cloud business, they're doing really well. And they came from behind on that and are doing very well. Their TPU business, that's chips. They could compete more and more with Nvidia. We're seeing that Anthropic is already taking the TPU or using Google's TPU. Google does own part of Anthropic. So there are going to be puts and takes here, but it's not going to be as easy for these companies as it has in the old world.
Right. And I think what you're saying deliberately, but also quite interestingly, is on one level, that data shift creates an economic threat. On the other, there's a certain amount of capitalization. And these businesses are surely going from being pretty asset light to having huge capex to build out this data competencies. So you could have a scenario where you're actually getting headwind from both sides.
Absolutely right. Most of the people who own these stocks have felt, these are cash fortresses, especially because in the last administration, M&A was shut down. So they didn't have to compete with each other in terms of spending this cash. They just let it build. And so the shareholder base now that they have did not expect this high fixed cost business to start dominating the headlines. Margins are going down. Maybe that gross profits and operating profits are going up, but margins are going down. So we're going to have a turnover in the shareholder base. Yes.
Yep. And we all know about Nvidia's margins. Now, you put out your company, ARK, puts out a really interesting, thorough, detailed report called The Big Ideas for each year. I was going through your Big Ideas 2025. I'm looking forward to the next one. And of course, I come from a more value bias in value. So a lot of this stuff, I'm scratching my head and I learned an enormous amount as I went through it, and a bit like your website, well done. Now you describe these 5 technologically enabled innovation platforms. They are AI, robotics, energy storage, public blockchains, and multiomic sequences. And you made a statement, or the statement is made, these platforms should drive exponential advances across industries and catalyze a step-changing global economic growth. So here's my question for you, Cathy. I hear that, I see it, and then I pick up the paper. Vista Equity for Partners, the largest software company in the world, former guest here, is laying off thousands of people. Amazon is about to lay off another 14,000 people. There's the US economy, which is 68 to 70% consumption as a percentage of GDP, and at the same time, people are losing their jobs. How can it represent a step-changing global economic growth?
Sure. And I'm going to give all credit to our analysts for big ideas, analysts and our directors and Brett Winton, our chief futurist. I am standing on their shoulders. And yes, that piece represents months of work each year. So how the history of technology is that it is a net job creator. Now, we will have displacement in the short term. And I think we're at a point in the economic cycle, certainly here in the United States, where, a lot of the economy, manufacturing is still contracting. Small businesses are having trouble getting credit. I know the headline numbers read fine, but I think it's because government was a big part of the push. In the last 4 years, high-end consumers are benefiting from stock market and housing prices. But the undercurrents are quite weak. And so that's, I think there's a cyclical dynamic at work. There is also a technology dynamic. The fastest increase in the unemployment rate in terms of cohorts, the fastest increase is in college graduates, and the duration of unemployment has extended to 30 weeks. Now, one of the things that I try and encourage, especially new graduates, to do is, go interview for those jobs. There are the jobs in this new world are going to be very remunerative, shall I say. The success rate, if a person moves to the right side of change, they're going to be enormously successful because we think that the opportunities are going to explode in these 5 areas that you mentioned. If you're a new graduate, go for it. Go start learning as much as you can about AI. If you have an idea for a company in your mind, go to ChatGPT and say, I want to start this company. Here's what I want it to look like. And you will begin building that company, and it will prompt you. You will prompt it. You will engage. Just start doing it. I think the personal agency that these technologies will enable is going to create a tremendous number of entrepreneurial opportunities for people who don't even understand they are entrepreneurs. All of us have ideas about the way something could work better. We all have new business ideas. I wish this worked better than that. Okay, try and make that happen. While you are also looking for jobs. My guess is, if our view is correct, that in the US, and I think this will happen around the world as the adoption of technology accelerates, that real GDP growth globally is going to accelerate from 3%, where it's been for the last 125 years, to 7 to 8%, powered by productivity. Now, nobody believes that. But in terms of providing some perspective here, if you look at the 400 years from 1500 to 1900, Brett Winton has done a study in collaboration with academia and has hypothesized, it's hard to get the numbers, that real GDP growth averaged 0.6%. That's pretty precise, by the way. Yes. Roughly half of a percent in those 400 years. We had a step function increase to 3%. That was a 5 to 6 fold increase in the growth rate. What I'm telling you now is that 3% is only going to 7 to 8%, even though we have 5 technologies evolving, not 3, 5 major innovation platforms. And with that growth rate is going to come jobs that you cannot even imagine now. And I'll just say one more thing. Anyone who's discouraged by the job market or is fearful, go to ChatGPT and my chosen one is Grok. Right. And put in there the question, what kinds of jobs will AI create in the next 5 years? But prompt it this way. Use futurists, use science fiction, use strategists, economists, use visionaries, and you will come out with a list of jobs that actually are surfacing new spaces. We think of as these jobs as being just here on Earth. Well, space is opening up, and AI is a part of that, and robotics is a part of that. Yep. The digital world is opening up. Many people say, what do you mean? It's been around since the internet. Property rights have not been around in the digital world since the beginning of the internet. We need a blockchain technology for that. For the first time now, we have immutable property rights in the digital world. And so that's another new economy that is going to evolve here. And the fastest way to pull people and countries out of poverty, this is proven, is immutable property rights. Okay.
Well, I've been advising my 3 children along those lines, but with less articulacy, so I'll have them listen to you when we release this. But 2 of those big ideas I wanted to put the microscope on above. One is multiomics, which I had never looked at or understood, so I had to look it up. I'd love you, first of all, just to explain what's the story.
So multiomic sequencing is the platform. So multiomics, it used to be called genomics. More people know that. But it's not just DNA sequencing anymore. It's RNA sequencing, protein, methylation, metabolics. We can sequence, we can understand so much more about the human body. So that's the platform. And we believe the most profound application of AI is going to be in healthcare as these sequencing technologies and AI converge. We think it's going to take the cost to develop one drug. Think about this. From discovery to go to market, it costs a company $2.4 billion if you include the failures along the way. And it has taken traditionally about 13 years to do so. We think that those numbers are going to go down from 2.4 billion to 600 million in the next 5 to 10 years, and from 13 years to 5 to 8 years. And when you have patent lives in the 20 to 22 year range, that increase in the number of years a company can sell a stock under patent is really important. So that's the first thing. Because of the convergence of sequencing technologies and AI, we are now able to diagnose cancer in stage 1 with blood tests. They're called liquid biopsies. And we're going to be able to diagnose many more diseases that way. And in fact, when it comes to colorectal cancer, we're probably going to be able to diagnose colorectal cancer before stage 1, because polyps also shed into the blood infinitesimally, but you've got AI helping us out here, and we're able to get better and better. And then the third, and maybe the holy grail here, in terms of convergence, is sequencing technologies, artificial intelligence, and CRISPR gene editing. Now that we can isolate mutations in the genome thanks to sequencing, we are going to be able to edit any mutations, which are programming errors. The older we get, the more programming errors we face. And wouldn't it be nice to have our geneticist say, well, from this year to this year, as I've sequenced your multiome, I see this mutation, and there's this therapy to address it. So you'll catch it early, maybe even prevent it. So brave new world. And this is not 5 years from now. We're already seeing cures for sickle cell disease and beta thalassemia. And CRISPR Therapeutics, the company with those cures, is also working on heart disease and trying to lower bad cholesterol for good with one treatment.
Well, we had Mike Milken on, and he obviously talked about that. And then at the recent Money Maze Allocator Summit, we had a healthcare panel, which Cathy of the Novo Foundation ran, and there was a absolutely palpable sense of it's here now happening, much as you said, from the biotech and the other practitioners. So maybe when we do our Allocator Summit next year, we'll have you there to be able to, talk about your perspectives. The other of those 5 themes was the energy and battery storage, or energy storage, I guess, and we all know the issues with intermittent power, etc. But there was a very confident sense of, I would call it a great leap forward in that domain. Please explain why such confidence.
Well, I think you've got Elon Musk leading the charge. That's one reason, the company, people and management. And Elon believes that ultimately everything will be powered by the sun, and that storage is going to become increasingly important because the sun is intermittent in many parts of the world. And the other thing he's said recently, to help give people perspective on the shortages we're facing out there, we are about 50% efficient around the world in our use of electricity. And that's because we could be with energy storage, storing up energy while the sun is powering business, and then overnight using that battery storage to heat or cool homes. So I think we're going to see a lot more increase in efficiency. That's part of innovation. But also because we agree with him that long term, the sun is going to power everything, then that energy storage is going to be a critical part of that puzzle, solving that puzzle.
Let's talk about risk. We get a lot of folks who come in with different questions. One was an ex-colleague of yours, William Johnston, from Alliance Bernstein, who said, I used to work with Cathy around the thematic growth. We need more Cathie Woods, he said. But then his question was, how do you define risk?
So the 6 metrics that I gave earlier, the bottom-up steps of our process, are not only helping us understand the opportunities, I gave you the opportunity side of it, but also the risk. And so we have a scoring system. 1 to 10 for each of those, for the first 4 metrics, which we can quantify. And some of them are more qualitative, like company management and culture. We know what we're looking for. Others, like R&D spending as a percent of total, less quantitative. Product and share leadership, we've got market share studies. So we are looking at each of those variables and moving the scores around as news comes out, telling us, in the case of management and culture, are they losing a lot of management team members who are critical to driving this vision? If we are, that goes down. Are they not spending enough R&D dollars in this space that we think is important? Our sizing of the position will go down. Is their moat being challenged by this new technology? The score will go down and the position size will go down. So we are moving those scores around all the time. And of course, the mega score is thesis risk, overarching risk. Is there something out there from a macro point of view that, most people looking at companies from the bottom up are not seeing? And is that important? So our scoring system is designed both to measure the opportunity and to discern the risks as well.
Got it. well, clearly your style isn't going to be for everybody. We might talk about a minute about when people think about portfolio allocation at a higher level, what might be the sort of the allocation. When you get a big drawdown, such as the one you had from 21-23, I think it was 70%, and the wind's in your face, what do you say to your investors?
So I'm going to answer that in two ways. One, what do we do during periods like that? We concentrate our portfolios towards our highest conviction names based on the scoring system I just described. So that's the first. So you'll never see style drift from us. That is the biggest risk when a market goes against a style. Often managers will try and add a little of this and a little of that, and before you know it, they've drifted away from what their clients thought they had bought, right? Okay, that's the first thing. Now, in this COVID period, the boom, we went up 150%. And as you mentioned, the bust, we were down 70%. Now, had we known that supply chain issues would last 3 years and disturb our unit growth dynamics, we would have done what we normally do towards the end of bull markets. We diversify into cash-rich innovators. That would have been the Mag 6. We mistakenly made the assumption, well, technology is going to take over and cure these supply chain risks pretty quickly because that's what we do. We see all the companies that are evolving to solve problems like that. And we thought they were ready for prime time. Well, they weren't. The system, what happened was we moved the global economic system so close to just in time that there was no room for error. We did not understand that. We did not understand that. So I think we'll never see a period like that again. And here's why. Governments now know that by throwing money at a problem, they create a lot of other problems. And we see China operating in this way. I just saw a news article recently that's saying that China's starting to pull away from government subsidies because they're creating misincentives, right? So, and I think that's very important and good for China. We might have a pandemic again, but I don't think governments will act in the same way. And we certainly are going to be much more focused on how much room for error there is in the system. If there's no room for error, we will be moving more towards cash-rich innovation names. We won't go away from our style. They must be innovators. That was our mistake. We started concentrating too early. However, I'll tell you, based on the last 3 years, I don't think the result would be much different. It would have made our clients feel better. We still would have had a significant drawdown, but if we had bulked up with more cash-rich names, I think clients would have felt a bit better given how little room for error there was.
So we have a few questions. We have this thing called the Outsiders Inquiry where smart people that we know, come in with these questions. And there's a very interesting investment organization called Curation Corp, run by Nick Feingold, which is a private investment club. And one of the questions from Philip Donald, who's a highly regarded stock market operator, said, to what extent will AI make much of the investment industry we've grown up with redundant?
Well, and let me give a shout out to William Johnston. I haven't seen him in years, and I thank him for that question because it's a really important one. So now for Philip, what's ironic about our industry, I described this move towards benchmark sensitivity in the last 25 years, and it's become pretty extreme, right? Well, it's rules-based, right? That a benchmark strategy is a rules-based strategy. AI is going to be very good at that. So benchmark-sensitive asset managers probably should think about pivoting into something less than benchmark sensitive, adding value in a different way. Because I do think AI is going to take that over. I think passive started the trend, and I think AI can finish it. I think our strategy, there's pattern recognition certainly involved in it. But there's a little more art than just science. So I described Wright's law. AI can figure that out. In fact, we're using it, it's cutting our research times in half. It used to be painstaking, and now AI is enabling our analysts tremendously. So Wright's law is an equation, and AI can do that. But you've got, and I described this with COVID, it's critical to understand unit dynamics. That's impacted by lots of other things: economics, geopolitics, all the risks that we do measure out there. So that becomes the art side of it. And I think taking new technologies out 5, 10, 20 years, which is what we do, AI is much more focused on what has happened historically. It kind of has to get used to a new paradigm. And so that's why we think we can remain ahead of the game, especially as technologies converge, right? Because they're evolving at different rates and they're converging at different times. So these are the sorts of things that just rules-based, pure pattern recognition based on a certain set of rules is going to need some augmentation by human beings. I'm not going to tell you that we won't be written out of action at some point, but we are moving forward, and that's the right thing to do. We are not looking backwards, which are what benchmarks are all about.
We've got to know Cathy Zhu, who runs Capital Today, one of the great VC businesses in China. She spoke at our conference a few weeks ago, and she said you recently increased your positions in Baidu and Alibaba. Please share your insights about China versus the USA in terms of AI competition in the long run.
Yes, this is very interesting. So we pulled out of China. We had roughly 20% of our portfolio in China. But when Jack Ma was banished, and then the online education was nationalized, and gaming was restricted, all of these were government measures, of course, we pulled out. And we've been focused on the mantras coming out of China. The first was common prosperity. To us, what that meant was, okay, the government wants these new technologies to reach into rural areas. And what it's saying is cut your prices and margins to do so. So that was not inviting. But about, I'm going to say 2 years ago, President Xi Jinping rolled out a new mantra called New Productive Forces. And as we were burrowing into that, we learned, okay, this is all about technology. And as we saw DeepSeek and learned more about that, we said, whoa, Chinese open source large language models, or they're called more open weights large language models, they are very creative with their algorithms. This is open source. And our technology experts, Jensen Huang and Sam Altman, just complimented DeepSeek and said, that was very clever. And they're now using that algorithm. So building on Chinese, I thought, wow. And then something else happened, which was, this happened very recently. So the concept of involution or anti-involution, as we understand it, what the government is trying to say there, to BYD, for example, is, okay, great. You're the most competitive electric vehicle manufacturer in the world. Congratulations. We're competing aggressively in the rest of the world, but we're also killing our own industry. Stop commoditizing. And so BYD and others, you hear a lot more about robotaxis from Xpeng and other manufacturers. They are going into the higher value add, just like Tesla, part of the market, the higher margin. And it seems like the government really is blessing it. So in our more narrowly focused portfolios, we do own Pony AI as well, and WeRide. And part of this is, recognizing that the government in China has decided that technology is where it wants to lead and how it wants to lead its economy out of this deflationary bust. And we think China is in worse shape than many economists think, and that this is a very important move to, harness new technologies and bail the economy out. Now, it's going to take a long time because that property speculation occurred over 20 years. And every downturn was a buy signal. And so many investors and consumers, 75% of their savings was in real estate, empty apartment buildings. So think about that. You're getting hit two places. The consumer savings are getting hit hard, and anyone invested in property. So we think it's, and there's one last thing. We know that President Trump and President Xi Jinping are probably trying to create a win-win situation with their own economies in mind, fighting for their own economies, but understanding that these really are the two most powerful countries in the world. And, if the old expression is, keep your friends close, keep your enemies closer. If you believe China is an enemy, as a great negotiator, you probably are going to want, if you want to become the most important president ever, as President Trump says he does, you probably want to create a win-win virtuous cycle. Get the bad news out this year. Let the economy boom next year, and before the midterm elections, with bringing China along as opposed to alienating. That's a little bit of what I think is going on. Could be wrong. But if that is what's going on, then we should have a higher weighting in China.
Well, former guest, Treasury Secretary Scott Bessent, might well be coming on. We think he is, and we might be asking him that question very delicately as well. And Sunik Clegg, who's left Meta, former British Deputy Prime Minister, had a question which was, what regulation would you like to see around AI, if any?
So we think AI is inning number one. It's a baseball term. It's like maybe the first quarter of a soccer game or a football game. And so to regulate AI right now would have been like regulating the internet in the late 80s and early 90s before we really understood its ramifications. Now, I agree with people who say that AI could be used for nefarious purposes, and all technology can be used for nefarious purposes. And the most important conversation out there right now is that it can be used for nefarious purposes. How do we guard against that? And a lot of that is happening in the private sector, which is important. And companies are evolving to prevent nefarious behavior. So I think that AI regulation has to be very carefully managed because AI is the biggest catalyst for all innovation today. It is the reason innovation is moving as quickly forward as it is, and it's going to impact every other technology and every sector and industry and company. So we have to think carefully. Of course, safety, security, is paramount, but we've seen other industries regulated out of business. And a really good one is nuclear power. If we had not regulated nuclear power in the United States in the 70s, electricity prices in the US, according to our estimates, would be 90% lower than they are now. Regulation really can hold innovation back.
Have you thought about giving an address to the European Parliament where that message seems to be least absorbed?
Well, as I go around Europe, I think one of the most hopeful things that is happening is policymakers are asking us and others, how can we jump into this game? How can we deepen our venture capital markets, our private enterprise here? And, half of the solution is understanding the problem. And I do believe there is an understanding that restrictions associated with AI, certainly Palantir has been very vocal. Alex Karp has been pulling his people out of Europe saying, we can't operate here if the threat is 4 to 7% of our global revenues when we don't even know. There's not even clarity country to country, on some of these rules and regulations. So I think that Europe is beginning to feel left behind. And even in the last year, what I am sensing, a year ago, no one had any clue that full self-driving worked. And because regulators would not allow Tesla's FSD in Europe. Now we're seeing regulators more friendly. Why? Because autonomous taxis will save lives. The human error is responsible for 80 to 90% of all accidents and fatalities. So we're going to save 40,000 lives in the United States by going to autonomous platforms. And I think around the world, the number is 1.25 million lives lost per year, right? So it's, I think regulators are beginning to jump on board.
So, Cathy, there are so many questions I haven't answered that I haven't got time to answer, so you're definitely going to be asking you back on the show, but I'm going to close with 3, which is recruitment in the world we now inhabit. What do you really want to see when you've got a young person sitting in front of you?
Yes, I want to see, given the way we're set up from a research point of view, I want to see passion, like obsession with the technology. We just hired someone into our blockchain group, and his hunger and passion for the space was very evident, but it came from a place where he just didn't trust the financial services sector anymore. And so he thinks blockchain technology solves that. He saw people losing their homes in 08, 09 and all of that. So some deep passion for some reason, and critical thinkers willing. Part of the interview process, I want to see if this person will disagree with me, or if I am disagreeing with this young analyst, how does he or she take it? And so I think that's really important. And the other thing is an ability to collaborate. So chemistry is important. So I am not the first interview. I'm the last. The first screen is, can you get along with this person? Is this person coming from a good place intellectually, and has the right kind of ego? We all have egos, and some are a little out there, and others are just right, healthy enough to, stand ground and not acquiesce if, someone who seems to be in a more senior position says something. We don't want that. We want real intellectual debate.
Got it. Now, you are a great advocate for female success in the world of investment management. We support the charity GAIN here in the UK, Girls Are Investors, and Will Campion, my co-partner, and myself each have 2 daughters. How do you encourage more females into the world of investment management?
Well, I would encourage them not to go into the benchmark sensitive part of our world, because I do think that's going to acquiesce to, AI driven solutions. I would encourage them, if they love learning. Remember how I was, when I talked about capital, I was so taken with the business where, wait a minute, I get to learn the way the world's going to work economically, technologically. If that interests people, this is the best business in the world. Now it's transforming, and it must transform. The pendulum moved way too far to benchmark sensitivity. And that is why individuals coming into the business now are more attracted to the private sector. There's more opportunity there. We want the public sector and the private sector lines to blur. We have a venture fund. We have the same analysts on both public and private. And I would look for that kind of a situation. If you love learning and you love to work hard and you want to be challenged, and you want to be in a place where you are free to challenge as well. Those are the kinds of people who do very well in our business. And I highly encourage it. Go for it.
And when we speak about resilience, when you are in, as we all are in the investment business, a period where we are struggling for all sorts of factors, how do you keep yourself grounded and, head above the water?
So most important is our research. If the market's going against us and certain stocks are acting very badly, we will obviously reassess the way we've modeled. But it's very therapeutic to then say, as we're doing that, okay, then we misunderstood the risk here. All of these other stocks are down as much. So let's consolidate from that stock into these other stocks. So research, keeping our eye on the prize, 5-year investment time horizon. And we have so much faith in Wright's law and the explosion in innovation that's taking place that I always say when we're down and out, I always say truth will win out.
And emotionally?
You've got to have an even keel. You have to. And emotional investors are the worst investors. They are the worst investors. They will sell at the low and buy at the high. And they'll always be a few steps behind, if not a few miles behind or whatever, however to say that, eras behind, whatever.
Yeah.
So, yes.
So Cathy, finally, your favorite book, your favorite film, and your favorite place to go on holiday?
Oh my gosh. I am so bad at these fun questions.
Well, we had to find one weak spot, didn't we?
Yes. Yeah. So favorite book, many people know it's the Bible, mostly because of how it's guided me along my life. But I will say in the secular world, The Emperor of All Maladies, The History of Cancer, just really learning that and saying, wow, we could turn cancer into life rejuvenation. We can actually do that. So read that book. Film, we were just talking about films. I'm a documentary person. I love watching how musical groups, especially from, the 60s, 70s, 80s, 90s, how they evolved. And there are always challenges, teamwork, all of that. But I love the music, so love those. You can pick any one of those. And the last question was? Destination,
your last holiday. Or one holiday, I'll rephrase that, the one place that you really want to go to if it was your last holiday.
I've been around the world a lot. And I think what I'd like to do is I have the privilege of seeing the business culture in each of these places. I think I need to take some time, and our partner, Amova, formerly Nikko Asset Management, is in Japan. I would like to know more about that culture, just maybe living in it. Same with almost all of the cultures. I love Europe as well, the lifestyle. And I'll give you one, when people ask me, well, what's going to be scarce in this age of abundance. And this is for UK, Europe. One of the good answers that has come back is the lifestyle that people in Europe enjoy. That is becoming more and more scarce, and I'm a poster child for this. And I would like to just go and enjoy and learn how to enjoy those, learn about those cultures, but watch how they do life, because it's just very different. And so it's a very general answer, but that's what I would like to do.
Fantastic. Well, I always conclude in these conversations, and I have written down on 2 pieces of paper so many things that I'm only going to take 3 of them. And one is that you, quite rightly at the start, and I think quite rightly because it's been clear, that you do not describe yourself as a tech bigot. You will move your portfolio around. You'll move to, very specifically, when certain situations have either forced concentration or recognizing that something isn't right and working. Number 2, that we perhaps don't appreciate why the world of medicine is absolutely sitting at a frontier of immense and immediate change. If we look at immediacy in 1-2 years rather than, in decades. And for young people worried about AI, very understandably, is that you've got to move to the right side of change. That may sound easier than necessary, but if they sit in front of you or your equivalent in an interview, they better be passionate, they better have known their stuff, and they better be prepared to argue. So, Cathy, it's been terrific. Thank you for so much time you've given us today, and I wish you all the best in the future.
Oh, thank you, Simon. This has been delightful. Thank you for all the homework you did to really understand ARK.